Hi, and welcome back to Investment Matters. I'm Paul Rosta. When I want to try to get a handle on the big picture of commercial real estate investment, I always find it useful to pick the brain of an executive from a global institutional investor. That's why I jumped at the chance to sit down and talk with Mike Byrne, the Chief Investment Officer and Head of Private Equity and Debt at AEW Capital Management. AEW has been around for 45 years, and Mike himself has been with the company since 2003. During our conversation, Mike walked me through the big issues he's tracking. He offers compelling insights about office, industrial, retail, and multifamily, plus a few words of caution. Mike also tells us about the formative years of his career, including the job he says was almost like getting an MBA in our business. And whether you're relatively new to real estate or you've been a professional for a while, Mike has some thought-provoking ideas about building your career. Just a brief note about the timing of this recording. We spoke shortly before the Middle East conflict started, so we weren't able to address the potential impact on real estate finance and investment. But I think it's fair to say that Mike's observations about market dynamics still hold true. If you enjoyed this podcast, I hope you'll check out CPE's Capital Markets newsletter, our free twice monthly roundup of the latest trends, analysis, and data in commercial real estate investment. It's easy to subscribe. Just go to commercialsearch.com/news/subscriptions. Again, that's commercialsearch.com/news/subscriptions. And now here's my conversation with Mike Byrne. Take a listen. Mike Byrne, welcome to Investment Matters. Really nice to be with you today.
Great to be with you, Paul. Thanks for having me.
Thanks for making the time. So AEW has a multifaceted approach to capital markets and investment. And as you look across this broad spectrum, are there any components of your business where you're particularly looking to get more active? And if so, could you tell us a little bit about what's driving your strategy?
Great, sure, of course. So there's no lack of change in the world today, right? We certainly find ourselves trying to change with the times. And so maybe just a quick second on AEW so you understand the platform I'm speaking from here. So AEW is a 45 plus year old investment management business where we act as both an investment advisor to separate accounts and direct investors. And we also act as a fund manager on behalf of some commingled funds and fund series. So that product lineup and that investor base leads us to invest in all elements of the real estate market, from core investing through opportunistic, and it also both equity and debt, and it also has us investing both in sector-specific strategies and diversified strategies. So when you add all of that up, it gives us a platform that has us active in all parts of the capital market cycle. And so certainly what's really important to us as a business is to make sure that we are offering funds and products to our clients that are both relevant and topical, and also align ourselves with from the fund in capital formation construct with what's most interesting in the market today. And there's certainly a lot to talk about. There's changing trends in the economy, both macro and micro. There are changing trends in terms of product development. There's changing trends in terms of how you organize your business in order to pull the most out of it and offer the best investment services to your client. So there's a lot to talk about there. It's a big question.
Well, let's take some of those issues one at a time. Along those lines, what is your 35,000-foot perspective on the key challenges that investors face in today's climate?
Sure. So, I mean, if you're talking specifically about real estate investment management, there's maybe more than anything else. There's three things that really influence outcomes in our business and investment performance. There's to make it really simple, there's interest rates, there's capital flows, and then there's the underlying property market fundamentals that are in the market. And we're at a point now in the first quarter of 2026 where two of those three things feel really solid, or I should say maybe significantly improved over where they were the last several years. For the last 2.5 years, we've been dealing with interest rate volatility in our business, which has been really challenging for investors to determine what their cost of capital should be, what their return expectation should be. It's caused us to, as an industry, wrestle with what valuations should be in our business. So that all introduced a lot of certainty into the market. To put that aside for a second, the second has been capital flows. Capital flows to the real estate space for the last several years have been really slow. As for all the reasons I just talked about, it was a hard thing for an LP or an institutional investor to allocate real estate dollars to real estate with that uncertainty in the market. But despite those two factors being uncertain or challenged for the last several years, what remained really resilient across most property markets were the fundamentals. And now we're at a place in the first quarter of 2026 where we have some interest rate stability, pretty clear direction from the Fed, and the expectation of further interest rate cutting. That's offered some stability in the market. I think you're seeing the transactions markets respond to that in a very favorable way today. So that's positive. The transaction markets opening up is leading, I think, partially to the increased capital flows into the real estate space today. We have a capital market that is fully functioning in almost every regard. There's debt capital for almost any real estate transaction you'd want to pursue. There's equity capital in most places, and equity capital at scale, I should say, in most places in the real estate capital markets. The only void maybe is core at scale. And yet, so those two things feel really good today, but we're entering this place now where the third element, which has been really resilient, is showing signs of moderation and perhaps some cracking in some places, which is the fundamental conditions in property markets. The one that's jumped to the top of the list for a lot of investors is what are the underlying fundamentals really in the housing market? How resilient is demand? Taking into account some of the supply that is being absorbed, some of the larger population trends that are being realized across different markets around the country. That's probably elevated from something that's been really resilient the last several years to being something that's a little bit, maybe a little bit more cautious in the real estate markets today.
Well, just to take a step back, Mike, did you want to elaborate on a different perspective, which is the economic trends that are driving your strategy as well, and that are posing both challenges and opportunities to investors and in the capital markets, but in the economy at large?
So trends, I mean, sure. I think if you're thinking about investing thematically in real estate, there's two mega trends that I think most investors are keen to focus in on. One is technology, either harnessing the growth associated with technology. And when I say technology, I'm really talking about the proliferation of AI and all of the capital investment that's going into that space today. So that's one theme. And the second theme today is demographics, and particularly the aging demographic in the U.S. Those are the two themes that are showing most demonstrably the opportunity to harness growth and invest into growth-oriented real estate strategies today. The third theme that's influencing trends today, maybe in a way that's more in our face than it has been in the past, is the impact of policy and the political environment in the market today. And normally it's often viewed as a third rail in our business to avoid. But I think it's today at a place where what was once described as black swans are now gray swans, where the risks permeating from policy decisions are no longer something that might just jump out at you. They're out there. You need to account for them in your investment decision making, probably in a more front of brain way than you might have had to in the past. So those are the big three themes to wrestle with today in terms of big themes. And then so you can invest, if going back to the first two themes, obviously today the places where the most capital formation is happening in our business is probably data centers, one, healthcare and senior housing, two, at least in terms of new capital formation. And that's really interesting. If you look across the other investable asset classes, what you see today is a lot less clear delineation between where the growth might come from. it's not today the case that industrial rent growth is going to be significantly stronger than it might be in other sectors, for example, which was the case for the last several years. And so those are some big picture things we're thinking about. I know I'm jumping around here, but if you go back to the last comment, which is politics, what we're starting to think about today is, if you go back to the last cycle, we're calling it the sector allocation cycle. A lot of alpha that was created in real estate. So a lot of the returns we all generated was from being invested in the right sectors at the right time. If you were overweight as an investor to industrial, for example, and you were underweight to office, so if you built those exposures in your portfolio, that's most of where your alpha came from. Well, today, the political environment is encouraging us to think equally about geography as much as property sector. And so one of the things we're spending a lot of time today is developing conviction and strategies around betting on locations around the country that are maybe recovering or growing at a significantly different pace than other parts of the country.
Well, could we delve a little bit more into some of the major asset categories? And let's start with three of the major food groups that AEW is involved with, which would be office, industrial, and retail. Of course, the office sector continues to get a lot of scrutiny. How do you think things are shaping up going forward, and how have the prospects changed for investment there? I mean, do you feel that return to office has picked up adequately for an institutional investor such as AEW to adjust their strategy?
So, I mean, I think we've been at this long enough to have a decent understanding for which office buildings are going to lease and which ones are going to remain challenged from an occupancy perspective. And so we believe that office is certainly an investable asset class. And we think there are office assets, many office assets around the country where you can confidently underwrite the cash flows of those office buildings and the occupancy that's going to be that will materialize over your hold period. So from that perspective, office feels underwritable. The challenge is when you move off and away from those very best buildings and try to determine the value of a building or of an asset where the occupancy future is less certain. And that uncertainty hasn't gone away. The green shoots we're seeing in the office market in places like New York City, the early stages of the recovery we're starting to see in San Francisco, those are certainly really encouraging signs. But I do think the other part of owning an office building, especially in some of those occupancy challenge situations, is what is the future capital requirement of the owner of these buildings into those buildings in the future? What's the CapEx? What are the tenant improvement costs? What are the actual dollars you need to spend in order to make that asset a first class asset? That remains really challenging today. And so I don't think the capital market for office is going to come roaring back the way we all might hope or want it to. But I do think we are starting a long healing process in that market, rationalizing in our inventory, and I do think you'll start to see it slowly, come back to life a bit.
There's a lot of buzz in major markets these days about repurposing office product for multifamily primarily. And to what extent does that look like it's going to be a significant solution for office properties that may no longer be competitive in their markets?
Well, I think it's a great. I think it's a great solution for real estate and buildings that occupy really important street corners and locations within major metropolitan areas that need to bring people back to their downtown. And so I think it's a really important endeavor. And I think with the right bones in place for real estate and the right development plan, converting a functionally obsolete office building into housing of some form is a really great plan. We are starting to see examples of where that has worked really well. New York City is probably at the forefront for where that has happened well, and I think you'll continue to see it well. Yeah, I'm sorry, I think you'll continue to see that happen. As an investment strategy, I think it's case by case. It's you really the concept of just painting with a broad brush and turning old office buildings into housing becomes really complex when you take into the considerations of any individual asset. Some of them might be more efficient and less capital intensive as projects. Some of them might introduce a lot more risk and complexity. So you really need to take them on a case by case basis. But I think as a society, it would be a great outcome to see a lot of renovation and repurposement of older office buildings. And there's plenty of cities that are doing it well today, but New York is probably on the front end of that.
And could you also share your take on the industrial and retail sectors? Where do you see the opportunities in those asset categories right now?
Great. Yeah. So industrial is a really important focus for us. We as a firm have a significant exposure to the industrial sector. We I think we've worked. The industrial market has dealt with maybe a year and a half or 2 years of headwinds, largely tied to a couple of things. Obviously, the tariff environment and the business uncertainty that's resulted from that, and especially the impact on major port activity, and with Southern California being the most obvious example, has been a challenge for the industry. When you layer that uncertainty and the pullback in demand that resulted from it, on top of a market that had a lot of supply delivered, and on rental rates that had grown 100-200% above their previous peak, that introduces a real challenge for investors to determine value and for the transaction markets to function effectively. And so we've seen a major pullback in rents in certain markets, and we've seen other markets hold pretty strong. If you look at the central part of our country, the fundamentals and the market conditions have remained pretty solid. So I think there's we're at a place now where we've recognized a lot of the adjustment that needed to be made in some of those high growth port oriented markets, and what we're starting to see is some real firming in the market, especially for big box vacancy. 2 years ago, if you had a 1 million square foot building in the Inland Empire or in a number of markets around the country, you might be really worried as you looked out at some stiff competition of several vacant 1 million square foot buildings. And I think you wondered where the tenant demand was going to come from. And just fast forward to where we are today, and there's a number of markets around the country where if you're a 1 million square foot user, you really don't have that many options anymore. And so that has happened quickly. We're seeing important occupiers like Amazon come back into the market in a meaningful way. And so I do think the industrial market has taken some medicine and is poised for some really strong fundamental improvement over the next couple of years. And when you sort of take stock of what the markets actually look like today, vacancy rates are actually still pretty reasonable. It's not like vacancy rates went to 20%. Right? Even in Southern California, I think vacancy rates went to like 10 or 11%. That's something that this economy and this country can easily work through and get us back into a place where we see some solid rent growth over the next couple of years. So I think we like industrial a lot. We've been very focused on some more niche areas in the industrial market. For example, cold storage and temperature controlled warehouses. And so we like to develop a fair amount of conviction for a user base or a sub-user base within any bigger category like industrial or logistics, and then make a targeted bet into buildings and warehouses that serve that customer base. And so we've been of the opinion that food and temperature controlled or products requiring temperature control have historically been really resilient through all parts of the economic cycle. And so we've been really focused on acquiring warehouses that serve that use. So that's been just one example of how we are navigating the markets today. You asked about retail too. I think retail is as fundamentally sound as we've seen in a number of years. generally, the centers we own and occupy, and the ones we've followed in the markets, are well occupied. They have a tenant roster and a tenant base that's significantly improved over what that rent roll might have looked like 10 or 11 years ago. There's been a whole host of really important and new tenants and merchandising concepts that have replaced antiquated concepts. We have generally a healthier tenant credit across the industry. And so the retail market feels incredibly good today. It's become one of the darlings in terms of product sectors for investors to focus on. And so, you always look to the strength of the U.S. consumer when you're talking about the retail market. And so that's something to watch, obviously. But retail is very much back as a favored investment class. And especially if you're thinking about acquiring at lower points in the risk return construct, acquiring core retail property today feels really attractive.
It really is kind of remarkable to me that it wasn't that many years ago when a lot of people seem to be saying, oh, brick and mortar retail is dead and everybody's going to be getting their products delivered at the door and nobody's going to go shopping anymore. And, to your point, look where things are today, right?
It's a cyclical business. And I think maybe retail is just the most recent example to prove that to us. I think San Francisco will probably be the next example to prove that to us. It wasn't that long ago that we all wrote off San Francisco as a market that would never recover. And if you've been to the Bay Area lately, I think you'd see that there's some really positive signs of life there as well.
Just to get back to one of your observations about the industrial sector, you mentioned that in some markets that we're at the place where that if you're looking for 1 million square feet, it's kind of tough to find right now. Does that suggest to you that there may be demand for some new large-scale build to suit in those markets, or is that a challenge as well, just because of finding sites that can handle that product of that size?
Well, I think that's a market by market, location by location concern. There are certainly barriers to new supply today, whether you're talking about suitable sites or a big one is access to power for warehouses. So there's certainly barriers formed and forming in that space or in that sector. But I do think the industrial market is healthier today. I think to the extent that companies have visibility in their business, they have capital that they're intending to use to grow, there's real demand for space. And so that's a really healthy thing for the industrial market. The challenge, again, not to underscore this too much, is just what's different about the industrial market today is just the volatility we're seeing in rents. It used to be that investing in the industrial sector was a fairly low beta strategy. Rents grew by 25 or 50 cents a year on a really good year. And you saw pretty consistent peak to peak rent growth in some markets, and in the bigger supply markets were more cyclical rent growth oriented. What you saw over the last decade was really strong exponential growth that was pulled forward and resulted in really strong rental rate increases. And what you look no further again than Southern California to see how far those rents have now fallen. That volatility is something is new to investors. So today, if you're interested in acquiring an industrial building, it's less about making sure you have your yield and your cap rate right. It's more about having some conviction for where you think rents will be over the next couple of years. And if you want to win, because it's still a competitive capital market to acquire these assets, you need to take a fairly full view of how much rents might grow over the next several years in order to rationalize the valuation.
Hi, Paul Rosta here. I hope you're enjoying this episode of Investment Matters. For more great investment and finance content, subscribe to the CPE Capital Markets newsletter. Just go to commercialsearch.com/news/subscriptions and subscribe today. And now here's the second part of my conversation with Mike Byrne of AEW. Could we talk about multifamily And I'd like to hear more about your strategy in that area right now. I've heard that senior housing is of considerable interest. So if you could speak to that or any other multifamily categories that you find attractive right now.
Yeah, so I mean, we invest in housing, in various forms of housing across almost all of our strategies, and so we think it plays an important role in most of our portfolios. We we like the idea of owning something that's need based and where the cash flows are incredibly underwritable. So housing as an asset class fits really well into everything we do, and it's maybe the largest asset market in the world when you consider all forms of housing. So so we today are finding real opportunity to acquire good assets. I'll call them, Class A multifamily assets. Generally today, because of the adjustment in the interest rate environment, compounded with some fairly deep supply pipelines that have delivered over the last several years, and in some cases, cash flows that haven't met the developers' expectations, we're seeing an opportunity to acquire assets at a value that's below replacement costs. And so for us, that's always a really attractive entry point. When you can acquire a newly constructed asset for less than the cost to build, that's interesting. And so we are certainly focused on building out our housing portfolio if that market environment sustains. The challenge has been, and it's interesting, as investors, we can't help ourselves sometimes. 2 years ago, we looked at building our housing exposure out with more haste, and we really wanted to be constructive on the acquisition side. And we said to ourselves, there's a lot of supply delivering. Occupancy might decline in the first year or two of our hold period. Rents might soften a little bit, but that's okay. We're in this for the long run, and we like our entry point. And not only we said that, the industry, I think, said that. Well, lo and behold, here we are now. Rents in some markets are softening, occupancies are softening, and I think we all forgot what we decided 2 years ago. And now the market's much more cautious on the sector. And so for us, listen, we think what we have across most housing markets in the country today is not a demand problem. We think it's a supply challenge, and we think the supply will be absorbed. So we're very bullish on continuing to acquire housing. We get more bullish when we get to the asset level and we find assets that really fit neatly and well into a current market. Whether the design of the project suits the customer base, or whether there's a specialized use that creates some sort of differentiation and makes it really important to that micro market, that's when we get excited and acquire the asset. We've been very focused on specialized use in niche sectors like student housing, and you mentioned seniors housing. The case for seniors housing today is probably one that your listeners have heard too many times before. But so I won't talk about baby boomers and all of that. I think that's pretty well known at this point. But the demand characteristics are off the charts. The supply characteristics are totally constrained and really favorable for owners of assets. The improvements in design and technology in terms of operating these senior housing communities is significantly modernized from where we were several years ago. And so there is some really strong market-wide fundamental improvement happening there that we're keen to invest into. And so I don't know the exact number, but I would venture to guess that more than half of our investments over the last 24 months have been in the senior housing sector. And what we're seeing in those assets relative to the rest of our portfolio is that the NOI growth is maybe twice, 2 times better than what we're finding in any other sector across our portfolio. And that's both from occupancy gains, so stabilizing pre-stabilized assets, and from top line rental rate increases. And at the same time, we always say that the capital markets follow fundamentals. The capital markets are quickly following in pursuit of that really strong income growth that we're seeing in our assets. And we're seeing cap rate compression, and we're seeing a lot of capital formation around investing in seniors housing. So that certainly feels like the product du jour in a lot of ways. And so we're really focused there.
To what extent is there a regional emphasis in your strategy? Certainly in recent years, there's been a lot of ballyhoo about the Sun Belt, a lot of activity there. And anecdotally, at least it seems that that is the source of at least some of the supply situation. But at AEW, how do you view the regional issue? Are you region agnostic in a way? Are you especially interested in big cities, suburbs, any particular regions? And are there any markets that you feel are maybe being underrated or overlooked right now?
The biggest social issue in almost every city around the country is housing affordability. So that dynamic makes housing investable everywhere, and so we look everywhere. Um, but we certainly have a bias towards investing in places where the risk associated with some form of rent regulation is less. And I talked about gray swans earlier. The political policy change around affordability and some form of rent regulation is a really real risk in many places. There's a ballot question on here in Massachusetts that we are contending with where if it passes, there's significant value degradation to happen across the entire state. So that's something you have to think about today. It doesn't mean you can't invest in housing in Massachusetts. I think we do and we will. But you do need to think about that as you construct your portfolios and make sure you have a balance of those risks across your portfolio. And um, so it is investable everywhere, but I think there's real risk in certain markets where the political environment is heightened, and so you need to consider that. At the same time, I think it's sort of undeniable some of the domestic migration patterns that are happening here, and there are clear places that people in this country are flocking to, and I think candidly that's probably more powerful than a lot of the headline issues around immigration, both legal and illegal immigration, and what that might do to the housing markets. The trends around people moving to Florida and moving to Texas and moving to North Carolina and moving to Idaho, those are pretty real, and we want to invest where people want to live, and so we'll be cautious to sort of manage the supply risk in those markets because that is always the consideration. But we don't think the trends around people moving to business-friendly environments and in tax-friendly environments and in warm climates is going to change anytime soon. So we'll continue to follow the people.
I'd like to change gears and hear a little bit more about your own professional journey. How did you get interested in the business? Was real estate investment on your radar pretty early, or was it more of a process over time?
No, I mean, certainly not. If it was on my radar early, I hope my parents would have talked me out of it. But I no, my career path was that I started in an investment bank in New York City. It was Solomon Smith Barney at the time, and became Citigroup when I was there. And I was, a grunt investment banking analyst that went through their corporate training program and ended up in their real estate group. And so that was the start. I found out quickly that I really liked the real estate industry. I felt like I understand it and connected it with it, and so I sort of just stuck with it and managed a career through that over the years. The interesting pivot for me in my career was when I left investment banking in New York City and came back home to Massachusetts, where I joined Mass Prim. And for those of you who don't know who Mass Prim is, it's Massachusetts Pension Reserves Investment Management Board, which is our state pension plan. And so I joined as a state of Massachusetts employee working on the real estate allocation of their state pension plan. And that was a great experience for me to make the pivot from banking towards the world of private real estate investing. And in my role there was ultimately about making decisions or supporting the board and the staff at Mass Prim around making decisions around how we would allocate dollars into the real estate sector. And so that meant determining what the risk return profile should be for our capital allocations, how we should think about selecting managers, whether we wanted to invest in commingled funds or whether we wanted to invest through separate accounts. I didn't know it at the time, but it was a really important education for the business that I now run and manage here at AEW around how you win client trust, how you stand out in a crowd and differentiate yourself from other managers, how you think about product development and aligning the interest between manager and so GP and LP. My time at Prim wasn't so long, but it was almost like getting an MBA in our business and understanding what was really what I think now I call on every day is really important to the whole ecosystem around real estate investment management.
And talking about experiences that have shaped your approach to business, what advice would you give to professionals who are still relatively new and are looking to build their careers in real estate investment or real estate capital markets?
Yeah, I knew you were going to ask me this question, and I wish I had a better answer. So I think my first, I get asked this. I think a lot of us get asked this question a lot. I think the most important thing I would say to young people, two things. One is find a good mentor, or maybe even a network of mentors. That's not someone to say just someone you work for, but someone that takes a vested interest in your career and someone that you can look up to and use as support and as a role model to emulate. I think if I look across our business or my peers at other companies, most of them, and I know myself, had really strong role models that to look up to. So I think that's a really important thing. And I don't think it's too early. I'm trying to encourage one of my daughters in high school to develop a network of mentors now that she can call on, whether she's thinking about college searches or choosing a major or anything. It's never too early to find a mentor, and in your professional career, it's even more important. So I think that's one. And since this is about finance and investing, the other thing I always tell our young people here is that don't ever underestimate the compounding nature, or the nature of compounding. And I'm not just talking about financial compounding. Compounding, progress compounds, your career growth compounds. Every little decision that might feel like a small moment is a small victory, and progress leads to more progress. And at the same time, problems lead to more problems. So take one step at a time, build on your successes, and you'll be surprised how quickly you get where where you're going, or how far you make progress, because you got to get a jump in the pool at some point. And if you just focus day to day on doing the little things right, making the little decisions, the extra work, the extra detail orientation in your presentations, it's amazing how those little details add up over time.
And to follow up on some of the points that you just made, when you think about the skills that are called on for success in the business now, compared to when you were coming up, is there anything that's changed in what rising professionals should be bringing to the table in terms of skills or attributes, or anything that you would add to what you have just discussed about mentorship and building a network?
I wonder if I'll change this answer in 5 years when we have a better handle on how much AI changes our business, but or maybe 6 weeks when AI changes our business. But listen, I think especially if you're in the real estate investment management business, EQ is as important as IQ. Relationships and people are really important. Leadership qualities are really important. And sometimes those are the things that you can't teach people. Whereas, the skill sets required to model a property or to negotiate a purchase and sale contract, those are learned skills. Developing interpersonal skills is really important. Whether you're talking about winning a transaction or developing a network to call on in your business to either build a property with a development partner, or to acquire an asset that requires an ambitious leasing strategy, having relationships are really important. So that's one. And then at the same time, it's equally important in terms of building trust with your client base. So I think IQ is one thing that I think really helps people stand out in this business.
Well, Mike, now we come to one of my favorite segments of the Investment Matters podcast, which we call Executives Off the Clock. Though sometimes it seems like we all try to work 24/7, the reality is that nobody can be on duty all the time. So when you do have a chance to take a breather, is there anything that you like to do for a change of pace?
Well, I am. I've got 4 daughters, So to my change of pace is whatever my four daughters want to do. And so I've got a 17-year-old, a 15-year-old, a 13-year-old, and an 8-year-old, and they keep me really busy, and they all have very different interests. So I find myself on the sports fields, in the auditorium watching a play, or you know, a choral concert. Find myself doing crafts sometimes on Saturday mornings with the kids. So my life follows theirs these days, and so that's a great break from the work week.
So a little bit of a lot of different things, and sounds like it just really keeps you on your toes at all times.
Does yes. It's great to have their support and to spend some time with them. So, and to follow their lives and all the great things that they're already starting to do. It's a great balance to life.
Indeed. Well, Mike, thanks so much for making the time in the middle of all of your busy doings to visit with us today and talk a little bit about what's happening in your shop and how you see the market.
Thank you for having me. It's been great, Paul. I appreciate it.
All right, take care now. That was my conversation with Mike Byrne of AEW. You'll find more CPE podcasts on our website, commercialsearch.com, and be sure to follow us on Spotify, Apple Podcasts, and YouTube. Until next time, thanks for listening, and be well.